responsible member.
It's the dawn of a new day over Mbeya in Tanzania, a country that has the potential to supply food to the region and particularly rice, for which it has a clear comparative advantage. Rice as a food and cash crop is the second most treated cereal in Tanzania after maize. It is grown in many parts of the country, but mostly in southwestern region where farmers grow the crop by irrigation and rain-fed production. Mbeya rice lands account for most of the national rice output. Most of the rice produced here is high-quality salo rice variety. A significant proportion of the lower-yielding but more aromatic rice, mwenda mbio, is also grown here.
Tuna mpango wa kutafuta masoko nje kwa sababu mashine ya kumenyea tunayo. Godown la kuhifadhia tunalo. Kwa hiyo issue hapo ni kutafuta, tuna mpango wa kutafuta masoko nje ili tuweze kuuza mchele badala ya mpunga. Tukipata soko Kenya, tukipata soko Uganda, tukipata soko Malawi, madam liwe soko tu lenye tija.
Naishukuru serikali kwa sababu kwanza imetujengea miundombinu. Tuna mifereji sisi hapa. Kwa maana hiyo tunaweza kulima wakati wote. Naweza kulima wakati wa kiangazi, naweza kulima pia wakati wa masika. Na hili bonde letu linakubali muda wote kufanya kilimo hiki cha mahindi.
The prospect for export of rice to the East African Community member countries, which now includes the Democratic Republic of the Congo, is immense. Kenya alone is a huge market. With an annual demand for almost 1 million metric tons against local production of only 180,000 metric tons, the shortfall is met by shipped imports from faraway Thailand, Pakistan, India, and Myanmar. A sizable 37,000 metric tons are hauled in by road from neighboring Tanzania. A review of the rice subsector by Equity Bank revealed that financial support of the whole rice value chain would not only increase production, but also increase stakeholders' income to ultimately transform lives and livelihoods. Equity's initial partnership with farmer members of Ipatagwa Rice Scheme reveals that there is a hunger for support of rice farmers who own between an acre and 10 acres. While financial support is necessary, entrepreneurship training is critical to ensure farmers practice farming as a business.
Sasa wewe kujua kwamba kule kuna soko, unahitaji mtu wa pili kukupa jicho, si ndio? Sasa ndio maana hiki kitu tumekuja sasa. Kuhakikisha kwamba tunaunganisha wakulima wetu, wazalishaji na masoko ambayo yako nje ya Tanzania. Kwa maana kama kuna watu wako Kongo, wako Rwanda, wako Kenya, basi wapate kujua kwamba sasa hizi tuna mchele ambao tunategemea wapi? Isenyera.
Mimi na familia yangu tunalima eka 7 na mpunga. Equity inawahisha mkopo kuleta. Kwanza haina usumbufu wowote. Sisi wakina mama tukikopa hiyo mikopo itatufaidisha sana kwenye kilimo, hasa hata kwenye pembejeo. Sisi wakina mama tukipata pembejeo nasi tutakuwa juu zaidi.
Tangia mwaka jana 2021 nimeweza kuingia kuomba mkopo katika benki ya Equity. Kweli niweza kuomba milioni 5 na benki ilinipa kwa muda mwafaka. Nilikuwa ninalima ekari 3 lakini kwa 2001-2002 nimeweza kulima ekari 12 na nilivuna gunia 187.
Ipatagwa scheme is but one of the 5 rice schemes that are over 1,500 acres each, with Mbuyuni at double that acreage. In all these schemes, rice is grown by irrigation from waters drawn from Kimani River, a tributary of Rufiji River downstream. During Nane Nane celebrations held in Mbeya, Tanzania President Samia Suluhu Hassan re-emphasized the importance of rice production at an event where farmers received delivery of power tillers from Equity.
Mheshimiwa Rais, tumetumia kama wakulima wa kikundi cha Ubaso kutoka wilaya Mbalali. Tumeanza kunufaika mwaka wa jana 2021-22. Tumepewa pawatila 35 kutoka Equity na trekta moja aina ya Mahindra. Zimetusaidia kutoka kwenye kipato cha gunia 15 mpaka kufika gunia 40 kwa heka moja.
Katika mwaka 2021, sekta hizi za kilimo zilichangia 26% kwenye pato la taifa. Zikatoa ajira kwa wananchi wastani wa 65.6 na kuchangia 65% ya upatikanaji wa malighafi ya viwanda. Pia zilichangia kiwango cha utoshelevu wa chakula kinachozalishwa hapa nchini kwa zaidi ya 100% na kuzalisha ziada kwa ajili ya soko la nje. Hata takwimu kutoka Benki Kuu ya Tanzania zinaonyesha kwamba katika mwaka 2021 bidhaa ya mchele pekee imeingizia taifa jumla ya shilingi bilioni 476.8 ikilinganishwa na shilingi bilioni 176.5 kwa mwaka 2020.
By far, the most challenging aspect of the rice value chain is marketing. A director of Ruhie Rice Milling and Warehousing Service Company, Raphael Mbaise, has 55,000 bags of paddy in his stores. The farmer Kamila started with 1.5 acres of land under rice, but today he produces rice on 200 acres. With 20 tons milling capacity per day, Mbaise could clear his warehouses by milling the paddy, but instead he staggers the milling because of a constricted market outlets. Mbaise's views have advised Equity's determination to partner with stakeholders on the rice value chain to provide project finance for warehouse construction and payment solutions for wholesale and retail traders.
Our rice is sold in various regions, say Dar es Salaam, Zanzibar, Tunduma, and Mwanza. But all these points, they are related to outside the country. So those who are taking our rice to Tunduma, they are looking at the Congo market. And those who are going to Mwanza, actually, they are going to Kenya direct.
The bank is ready to provide asset financing for mechanization of farming and for transport of exports and imports to various destinations across East Africa.
So we as Equity Bank, we have committed that we'll link our farmers to those markets because they appreciate that buyers from Congo DRC, buyers from Rwanda, Kenya, they offer them a reliable market and good price for their produce.
Rice is not the only crop grown in the region. Maize, the most traded cereal in the country, is also grown here alongside wheat, beans, peas, and soya. Indeed, not far from the rice fields of Ipatagwa is the maize growing farmlands near Ilaji in Uswahilini. Maize is grown by irrigation and from rain in season.
Nimejipanga Equity ikinipatia mtaji niweze kulima zaidi hata ya eka 5. Natarajia kuuza soko la Inyala. Natarajia kuwauzia watu wa aina mbalimbali, kwa mfano Kenya, Malawi wanakuja kuchukua zao letu la mahindi.
Kweli kuna changamoto kubwa ambazo huwa zinatukabili sisi kama wakulima wa kilimo cha mahindi. Changamoto ya kwanza ambayo ndio kubwa ni ukosefu wa mtaji. Kwa sababu tunashindwa kuzalisha mazao mengi kwa sababu hatuna mtaji ambao utatuwezesha kuweza kununua pembejeo za kilimo kwa wakati, hususan katika upande wa madawa na upande wa mbolea. Halikadhalika hata mbegu bora ambazo tunaamini kabisa Equity Benki wao wakiweza kutuwezesha, tunaamini tunaweza tukatatua hizo changamoto kwa wakati.
With a 200 million people market in the region across the middle of Africa, trade in agriculture will grow, supported by Equity's Africa Recovery and Resilience Plan.
The strategy we have adopted is the African Recovery and Resilience Plan. We have leveraged on the East African Community Common Market and leveraged on the African Continental Free Trade Area. It's a regional plan, it's a continental plan, because we have realized the only thing that can support us to succeed is the market. The larger the market, the better.
Agriculture industry players in Tanzania and across the East African Community member states are encouraged to tap on the 700 billion Kenya shillings plan to feed the region.
Every day, over 15 million members are transforming Africa. $15 million members empowered to learn, to create, to grow, to harvest, to lead, to dream. Equity. Karibu member.
When dealing with foreign exchange, time and speed is of essence. Sometimes there is no time to visit a branch or make a call to negotiate for forex rates. This no longer needs to be a problem. Introducing EasyFX, a secure and convenient platform that gives you the freedom to buy or sell foreign currencies in real time. With EasyFX, you can enjoy access to competitive forex rates, real-time deal settlement, place buy and sell orders, real-time streaming of rates across
manage inflation rate of 10%. Europe is at 11, America nearly 9, Kenya 9, and the entire region. So somehow we are affected the same way in terms of inflation and in terms of the response to inflation. The response to managing inflation has always been interest rates, and we have seen the spike of interest rates. The spike of interest rates then influences the flow of capital around the world, chasing yields, chasing stability, and moving away from risk and priced risk. So that is the turbulence that we'll be seeing. So it's a very good perspective of how you add one challenge and enter into another challenge. Remember, the objective of the strategy that Equity adopted was to build resilience in the organization, agility to such that future shocks, when they come, the bank is well positioned to manage. So we'll see how we intend to manage the new and the lessons that we have taken. If we move to the next slide, Alex, because this is more for reading, we see the central banks have started responding. They have started increasing interest rates to manage inflation. The currencies depreciation almost the same across the region uniformly, because it is depreciation against the US dollar. So as the US dollar strengthens because of interest rates, the currency of emerging markets where we happen to be then take a very huge hit. The growth rate, we can see the region we are operating in seems to be one of the most resilient regions in the world, maybe at the moment earning the reputation of one of the fastest growing regions in the world. But we also see inflation within the bandwidth of global inflation rates, again reflecting the resilience of the economies. If we look at our response to COVID, it was now COVID is behind us. What are the lessons we have learned from COVID, the resilience we build, and can we use those lessons to position ourselves, but more importantly, to have significant impact in the region we operate. And the African Recovery and Resilience Plan is our end product out of COVID. We learned the lessons that yes, we shielded our customers, they survived, they thrived, and we asked ourselves, can we now focus on economies? Because that COVID, we focused on our customers. We rescheduled loans for 32% of all the customers, 171 billion shillings. We became masters of customer relationship management. We became mentors and coaches, and we realized the survival rate of the businesses that were banking with equity was almost 98%. We realized give the period we accommodated them, allowed them to repurpose, to retool their businesses. Our continued ability to fund them at the rate of 30% growth rate in the loan book allowed them to pick any green shoots during the turbulence, new opportunities. And we said, wow, what a lesson. What about if you scale that and look at whether you can support an economy as opposed to a customer? And that is how the African Recovery and Resilience Plan is drafted. It's our new strategy that we became resilient. Can we sell that resilience to the marketplace? And broadly, we have 6 pillars. It's agriculture and extractives or natural resources, or productivity gains there, then using the productivity gains output to establish manufacturing, using manufacturing output to promote investment and trade globally and in the region, focusing on East African common market and African continental free trade area as an area of great focus, formalizing the informal sector to populate the value chains of manufacturing, agriculture, mining, and even trade, and getting the citizens to actively participate in formalizing their economies and becoming part and parcel of the value chains within the economy. And then looking at social investments to ensure nobody is left behind, health, education, capacitation through training, through guarantees so that everybody participates in economic activities. And also looking at the impact of environment with a really deliberate effort of ensuring there is no deterioration in terms of environment. So huge focus on environment. And lastly, recognizing the demographics of the African continent, an average age of 18 years, well educated, and hence advocating the use of technology, particularly the fourth industrial technologies, so that Africa can leapfrog, so that Africa can build on the efficiencies, the technology. But that plan, when it boils down, how does it affect the people and how does it affect business? It boils down to equity, reaching 100 million customers, 25 million households having loans at any point in time, 5 million businesses, particularly small and medium enterprises, having loans at the same time, so as to catalyze and to orchestrate transformation with those sectors and to enable the working capital. And in the process, each of the 5 million enterprises creating 5 direct jobs and 5 indirect jobs within their ecosystems and building 100 million customers. That is their vision out of the lessons of COVID. Build society, transform society, and transform the enterprise, because it provides the rails of execution, and it's executing through financial tools, and financial tools is the domain of the enterprise. And so the question is building partnerships and collaboration. So broadly, very pointed, recognizing agriculture is central. So 30% of the balance sheet allocated to agriculture, 15% to manufacturing and to support industrialization, but 65% allocated to the citizens, the small and medium enterprises, so that truly the economy is in the hands of the citizens. So broadly, that is how the plan turns out in terms of numbers. And those numbers, hopefully, the plan that is converted through those numbers to a business plan. The resilience plan is a strategic plan for our economies, for our people, for the bank, but there is a business plan that builds up those numbers and creates deliverables around those numbers. So that is where we are, that's where we start. As you can see, we are starting on a hill of confidence. And we are starting on that hill because we have survived and emerged much stronger. And we have emerged almost fully transformed. The bank is not the bank we had in the beginning of 2020. The bank we are closing with 2022 is very, very different. And we'll see that in the numbers. So if we continue, Alex, we'll see. So broadly, execution, we'd like taking you through the operational aspects. It's good to strategize, but it's better to execute. So this is the execution metrics that focuses on the key drivers of business, the critical path, so that you really know what makes equity. How is the energy resources allocated within the equity group? So if we look at the non-funded income, and we're very, very excited about this forecast, the non-funded income, as we can see, grew by that 1%. What is exciting us is that it grew faster than loan interest income and even gross interest income. The objective was to focus on non-funded. Why? Because we know analysts, investors place a premium on non-funded income, and truly that is what we have delivered. A growth of 31% compared to 20% growth on interest income. And when we dig deeper, and I hope we'll follow, we have created new streams of income. This is not a one-off. This is the new norm because it's new lines of business, and we would explore them closely. Because of that growth, non-funded income is now contributing 41% of interest income. Non-funded is contributing. So when you then break down in the next slide, you then see trade finance is the biggest driver of non-funded income. The bank is of age. It's now sophisticated and complex to use financial tools of trade finance to support the whole region. Why? Because we are focused on cross-border trade. And you have seen us take our customers across the region in terms of our missions. And most of the loans, we are now cash flow, it's cash flow based lending, because as we can see, trade finance related lending grew by 84%. And we shall see loans grew by 21%. But in that 21%, trade finance related lending grew by 84%. And we can see trade finance revenue not being left behind at 69%. And the real off-balance sheet volume of trade finance are growing by 39%. So we can be excused and understood hopefully if we called ourselves the trade finance bank of the region. That's what, it was an ambition that will be the #1 trade bank. So what equity aspires, it makes it deliberate to pursue, and that's what we have been pursuing. And if we go to, then we can then see how that positions us relative to other banks in terms of differentiation. So again, we could see a huge opportunity there for us to be considered for a differentiated pricing in terms of quality of earnings relative to other banks because of non-funded income. And non-funded income, remember, it's realized income, is income that broadly customers could then focus on. I will move on despite the challenges you are having. I hope Alex will sort you out. Me, I had a backup plan, so I'll turn to the backup plan and continue speaking. Alex, you have been able to, you have jumped a couple of slides, so go back one slide, Alex. Sorry, I will speak a little bit about treasury. And let's look at the funded income. When we took at the funded income, and again, we said interest income and non-funded. Of the funded income, interest income, we can see Treasury controls 32%. Again, that is interest income on sovereign risk. So there's no provision that most likely will come with that income. That is realized income. It's income on treasury bills and income on treasury bonds. So you can see the balance in terms of the stream of income. That's just broadly. Well, it's one thing I saw a debate during the last time. Markets are what they are, and I've then decided to mark to market position our bonds. Because of yields going up, the value of the bonds had shrunk. At the reporting date of that year, the September, we were down to 65 billion. But market being what they are, we have recovered 22 billion, and we are now down to 44 billion. So this is not a number that should ever worry somebody. If you have liquidity, you hold to maturity. That will never materialize. And it will just be reflecting the market pricing. So it shouldn't bother anybody. We have sufficient liquidity. We will never mature instruments when they are underwater. So it's, for me, it doesn't reflect equity. It reflects the way the market is behaving, and it confirms the volatility because of interest rates and exchange rates. Going to what we focused on. When we became the largest bank in Kenya, we were worried that will this represent a sovereign risk concentration? When you create a trillion shillings balance sheet, you don't want it to be fully concentrated. I want to really applaud the team, because as we can see, the Kenyan sovereign risk has been de-risked up to 40%. Kenya is now 60% of our balance sheet. We have achieved the ambition faster, 3 years ahead of our target, where we wanted Kenya to be reduced. It now shows by the 5th year, Kenya will be below 50% of the entire balance sheet of the bank. What means that the regional subsidiaries are growing much faster than Kenya. But what has maybe you may wish to notice is that deposits, the subsidiaries are contributing 44%, loans that is 7%, assets 42%, revenue 43%. That tells you that the model of the subsidiaries is precisely a replica of the Kenyan model, where one curve represents all the parameters. The efficiency of Kenya. So broadly, it's Kenya scaling itself with the same efficiencies that equity has and the same model, an equilibrium model of intermediation, that what comes in is quickly transferred to assets, and a very efficient machine in revenue generation and of course profit. Despite being young now, the subsidiaries are contributing 35% of the profit of the group. But I want to draw the investors to return on asset. If you look at average return on asset, we see the subsidiaries now have hit 22% or above the cost of funding. So we could have debated in the past about capital allocation. Are we allocating capital appropriately? We have been validated that the subsidiaries now are above their cost of funding, and consequently their positive contribution. And the fact that they are growing faster than the mothership, it then means that for the investors, they can continue to look at an upside because that growth is value creative growth, which is faster than Kenya. So moving on and then turning specifically to individual subsidiaries or disaggregating all that, then we can see what is happening. I don't want to celebrate South Sudan is too early, but it's nice to see the subsidiaries beating the mother, Kenya, which is a return of 32% on equity, and Rwanda being ahead at 33.7. And broadly, even the youngest kid on the block, Equity Life Assurance, also on its first year, 9 months, giving a return of 16.8, maybe showing again the dynamics, the capabilities of this group. But what really excites me is the cost-income ratio, and we are seeing the greatest success of this group, and I want to draw attention a little bit, is Equity BCDC. And we can see in just 1 year, cost-income ratio dropping from 73.5 to 62.8, and we hope that momentum. So when you match the growth rate, maybe Alex, you can move one slide back. Just look at the column of Equity BCDC and see how the growth rate is. It's the fastest growing subsidiary. And then you look at the cost-income ratio reduction, then it shows you why we have very kind words our voices become very gentle with a lot of respect to our team in DRC for the great work they are doing. And when we say the possibility of DRC being larger than Kenya in 5 years is now no longer a possibility. It's a reality in making. But growth is good, but value-creating growth is much, much better. And when you are able to reduce your cost-income ratio by 100 basis points, or 1,000 basis points in a year, then it shows the capability of synergies. It shows the efficiency of the group, if I may add that. So that slide, and we can see that truly the subsidiaries are following the same model. The next slide shows it better, and we can see the race to a 4% return on asset. All the subsidiaries are headed there, and 4% return on asset is a very, very high return, and looks like all the subsidiaries will be there shortly. And again, to the investors, that should really be an indicator of the future. This map is becoming more brown and brown, but what we celebrate most is that we are now a systemic institution in the entire region. The #1 bank in Kenya, #1 bank in Rwanda, in DRC, #2 bank in Rwanda, and #5 bank in Uganda. So it's the strategy, as we can see, is not about opening subsidiaries. It's opening meaningful investment, systemic investment. As you go focus in a country and really grow to extract value. And the reason why we celebrate being systemic is because of what is happening in the underlying economy. And we can see in the underlying economy massive opportunity for credit penetration. We're in economies where there is very low credit penetration. And then when you are systemic, and you define how the economy grows in financial inclusion, financial access, then you can see the potential size is what has happened maybe in Kenya. When we see infrastructure is being put rapidly and rapid growth, trade in the region is being enhanced, then we see the future being much brighter than ever before. The focus on regional trade, the focus on African continental really hold the silver lining in every challenge this group would be looking after. So each of the countries we have analyzed, we are comfortable with the risk of each country. And the strategy is to deepen presence in those countries, become significant, and we can see how the infrastructure has been laid on. This then gives the balance sheet figure, and we are happy to say, I saw an article about equity breaches, the 1 trillion shillings customer deposit. It's true. I wish to confirm it. The journalist said I couldn't be reached, so I'm now reached, and I confirm that we exceeded 1 trillion shillings with 7 billion shillings. And so we were not growing at 323 million shillings per day. There was 7 billion that was not divided. So it's almost 330 million shillings growth on daily basis, and hope will sustain that. That momentum seems to be. When I asked what is powering this extraordinary growth of equity, then the answer is clear to all of us. It's the customer's decision. It is a liability-led growth. It's a market-led growth. And that's why we focus on efficiency. When customers give us deposits, what do we do with the deposit? And we have said our responsibility is to lead, intermediate in the same market, take back the money to the market. And we can see how that funding is playing out. So the balance sheet, as we can see, is nearly 1.4 trillion shillings. And looks that it took us 38 years to build the first trillion. Maybe, I think it's now evident, the second trillion will be built under 5 years. That is, as if you take that daily growth rate of 330 million shillings, then the second trillion will appear in less than 5 years. Now, why am I emphasizing that? Is because the infrastructure has been invested, the cost has been incurred, so that growth can be significant value-creating growth, very significant value growth, creating growth. And we'll talk a little bit about the efficiencies that we are seeing. 15% growth in deposits. We are humbled by that commitment during a COVID era, growing very, very fast relative to the economy and relative to the banking industry. So it simply means market sort of consolidation, an increase of market share. And we can see that when we receive 15% growth in deposit, we accelerate lending, and lending is growing at 21%. And we can see the mix of assets. COVID is behind us. There is no more parking of money in government treasury boards. The market has bounced back. The demand is back. So we have 21% growth in loans, while there is only 1% growth in government investments. So we have gone back to the market. We want to stimulate the market. The African Recovery and Resilience Plan speaks to stimulating the market, leading to 6 sectors, and we shall see ourselves significantly removing the money that was parked in government stocks to the market. That is an opportunity for investors to see that asset reallocation will move returns from maybe an average of 9 in government stock to an average of 13 in the Reading portfolio. So profitability growth in equity is not primarily an issue of growth in balance sheet, is the allocation of low earning assets to high earning assets category. To me, that's where the greatest growth will come from. That increased spread, so you can now predict how equity will be, and you can place your bet with certainty because we have demonstrated what the strategy is. It's no longer about parking cash. It's all about now increasing lending. And that's why it is only the African Recovery and Resilience Plan that has had the capacity to give us an opportunity to reallocate these 400 billion shillings in government stock and 200 billion in cash into the productive economy. That is increasingly becoming easy because the bank is digitized, and we can see what then means. So the next trillion is coming from, and hopefully will be reached before the end of this year, is on digital transactions. As you can see, we are 964 million transactions. So easily that is now the fastest growing capability of the bank. We have delivered ease, we have delivered convenience and to the customers. And we can now see how the movement is. So the value of those digital transactions, as we can see, is nearly 7 trillion. We used to associate digital money with the telecoms. The environment has changed. 7 trillion of value of digital banking transactions. And that only compares to 3 trillion of what is on the brick and mortar. So banking has moved. Banking is not any longer where you go to your branch to see your manager, is what you do on your devices, and specifically the mobile. And that is how equity is delivered. And so the value proposition of equity has moved from just being good products, great service, to convenience and ease of lifestyle. You now have your bank wherever you are, and you can transact wherever you are, whatever time it is. Just a few clicks and everything is done, including borrowing. That ease and convenience is what is likely to power the growth. That growth is likely to be sustained for a long time because of the mean age of 18 years of our demography. This is their choice. So as the bucket of population, youthful population grow. And we can see what has happened. If you look, and this, I'm seeing this conversation a lot on social media. Now, the channel of choice of payment is now Lipa na Equity. They are calling it Pay with Equity. It seems to be now the most popular product. Why? Because Equity chose to zero rate it. It's free. You can do all your payments. It's free to the shopkeeper. It's free to the shopper. And it's free to the supermarket. It's free to the shopper in the supermarket. We decided to reach out. The second fastest growing channel is internet banking. And we can see EasyNet on the smartphones and how fast that is growing. So very, very rapid growth. Again, that reflects the trend of smartphones. The Kenyan population is moving towards the smartphones, What that means is that the playing field is being leveled, because once it is internet, it's no longer dependent on telecoms. We can do the transactions independent. We could confirm the capability. But for me, while the legacy systems of branches, ATMs, maybe merchants and agents, the number of transactions have reduced dramatically. Look at the volume. The volume going through the branches has increased by 34%. The volume on agents have gone up by 70%, and even the branches. To me, this is an indicator of the health of the economy. This is the recovery of the economy. As we can see, it's not number of transactions, it's value. The number of transactions are flat, they are negative growth, but the volume. So business is coming back, and we are very confident. Yes, we still have new challenges of inflation, interest rates, but the business have recovered, has bounced back, and we call that the best rewards we could ever have achieved or gained from our intervention to support our customers. When it comes to channels of choice, it's apparent now, even on volume basis, the customers have moved to mobile and internet banking. And that seems to be the future of banking. And we can see even the loans, we have moved significantly in number of transactions. The transactions, we have seen how transactions are really using what one would call fintech capabilities, very strong capabilities. And so the volume doesn't has corresponding cost, because the systems are very, very scalable. And the digital capabilities, Alex, you're very fast, but thank you for, it's purely quite heavy. And that one capability that now Equity can easily pass for a digital bank. So if you rate digital fintechs bank different from legacy bank, please upgrade us. We are a digital bank, as we have seen. We are a fintech bank. We are not your old kind of, give us the valuations of fintech banks. Now, we have talked a lot where the likely stream of income is likely to be. It's purely transaction banking. But the intermediation, where we have been very strong, as you can see how we have managed risk. The risk of lending, and people have always asked me, James, how comes Equity is able to achieve better NPLs or quality of loan book than the industry? It's because we are inclusive and we are diversified. Our segmentation, the segment, we participate in all segments. And so the concentration of risk is managed very well. Economic sectors, as we can see, we are all in all sectors. None of them is dominant. Neither is the segment, neither is the sector. Do we have any dominance? And when it comes to currencies, as you can see, the foreign currency, principally the dollar, is almost half of the loan book and the currency. So when there is movement, maybe that's something people might have missed, when there is movement, the local currencies are going in the opposite side with the foreign currency. And so it results to zero net effect, because when the local currencies are losing value to the dollar, then the dollar loan book is gaining value. So essentially, our loan book or our balance sheet, it's very well insulated from exchange, currency exchange volatility. because half of it is in foreign currency and half of it is in local currencies, and that is how we shield. We have seen again the sovereign risk. The concentration in Kenya has been reduced down to 65. Let me take a few minutes and then talk, and this, Alex, is very exciting. As a result of that, our NPLs are 9, edged a little bit from 8.5. The industry is still at 14. So we are 500 basis lower than the banking industry. And we shall see. The good thing is that that entire loan book is fully provided for. 95% of the loan book is provided for through provisions, cash, and when we take guarantees, we go all the way to 121%. So we are not carrying a risk in the books to take into the future. And that really differentiates Equity Bank from any other bank in the region, where we would say our coverage is maybe double the average for the banking industry, despite having a very good quality loan book. Alex, I don't know, you seem to have taken a slide. I would like to talk about, this slide, Alex. The provisions, as we have seen, the coverage, and we're very, very happy. And this then also tells me to speak a little bit to the next slide about the 171 billion that we had rescheduled under COVID program, and to say 50 billion has now been fully paid out of 71, 105 is fully resumed, and out of the entire loan book, only 9.5 billion is trained, and that is fully provided for. Of the remaining portfolio of 7.7 billion, all of it is resuming repayment by the end of this year. It is the next 3 months from 1st September. We have downgraded 2.7 out of that, and fully provided for that downgraded. So there is no risk that we have left behind. We have been really proactive. So that's how we have exited from the COVID environment. The accommodation we made has been unwinded, and we are feeling very confident as we approach the next phase, because we are not carrying any legacy of approach or impact of COVID. Fully provided the loan book, 95%, and converted the entire COVID rescheduled book to performing, and the 9.5 out of the 171 fully provided for. So we are very confident going into the future. And broadly, these numbers of ratios talk about one thing: the efficiency that is building up in Equity. Look at the cost-income ratio for the group. It has come down from 48 to 47. I think that's the only number that I want to emphasize on. 100 basis point decline in cost-income ratio. We have given you for every subsidiary, and you can look at that. Now, critical is to see how has this money been made. When we are celebrated every year as the bank with the lowest charges, you can now verify the average yield on our interest earning assets is 9.8. Equity doesn't make money because of high interest rates or high charges. For 12 years, we have won the award of the bank with the lowest charges in the market. 12 consecutive years. Here is the evidence that interest rate has been lower than where inflation is. We are preserving just the value of our money. It's not about, and that then confirms the equity model. High volume, low margin. You bring affordability. You will bring growth and be satisfied. This really is what has built equity to be. And very inclusive bank, the bulk of money comes from transaction fruits as opposed to fixed deposit. So that explains the model of equity, and we can see how equity is performing. It's the efficiency, cost-income ratio, is the quality of the loan book. That's the secret behind equity's superior performance throughout. And of course, the second engine, the social engine, the Equity Group Foundation initiative that helps us to do good while doing well. We have seen how well we have been doing. See how good we are doing in society. And this is coming to at a time, just out of the blues, just want to remind you, we dedicated 1.7 billion shillings to support the country. We adopted 116 hospitals. We have sustained them with COVID PPEs to date, and we still have enough to sustain, as hopefully Dr. Joan, for next year. Do we have enough money to do up to March next year? We committed we'll do it to the exclusion of the sponsors of those hospitals. 116, every county one, 66 mission and faith-based hospitals that support. And I'm glad that this week the board also approved that we could focus on the famine situation, and we committed 120 million Kenya shillings, $1 billion. I saw last night the government decided to adopt the model that we insisted on COVID, and the private sector has been given the mandate to coordinate that, and I'm glad Equity has been given a seat on that board, and hopefully the money that is being distributed will be. The franchise continues to be really powerful, award-winning, national, global, award-winning franchise. Now in the top Fortune 500 banks in the world, and we celebrate this because it energizes us. The Marshall Plan has been adopted by the Commonwealth, adopted by the African Continental and East African Community, and we have signed agreements with them, and the market continues to have very powerful sentiments about it. As we can see, equity is valued almost 50 billion shillings, bigger than the second valued bank. So now that brings us to the balance sheet, and as we can see, I think we have talked a lot about it. 1.363, roughly 1.4 trillion shillings, driven heavily by deposit. We said we had partnered with the development banks to fund the Marshall Plan. You can see they have brought the money. It's on the balance sheet. That explains the 45% growth. The 16 banks have committed, as we need, up to $24 billion. As you can see, $1.5 billion has been released and is on the balance sheet. Ideally, not much other than loans are growing faster than deposits, suggesting we are now growing back from where we had placed money during COVID. And that then brings us to the P&L, and Equity registers profit before tax of 44.3 billion shillings, a profit after tax of 34.4 billion shillings, a 28% growth in profit, and of course, earnings per share growing at 27% and positioning the shareholders well. I think it was worth the 2 years they missed dividend. The earnings have bounced much better than before COVID, so it was a solid investment. But I think the secret is in ratios, so let me take a few minutes just to focus on the ratios. As we can see, the returns are now at 28% return on equity and 3.5 return on assets. Now, this ratio, financial ratio, speak about how well equity is positioned. And 2 ratios I would like really to raise, showing how the buffers of equity has been built. Let's look at liquidity. Liquidity of the bank at the moment is at 51.8, showing how powerfully the bank is positioned to face the future. Liquidity by regulation is supposed to be at 20%. We're almost 3 times above the minimum, or 2.5 times if you want to be precise. Now, look at capital buffers. The capital buffers, capital is at 16.1 as opposed to 8, and 20% as opposed to 14, the minimum capital requirement. So the bank is very well positioned with very strong capital buffers, liquidity buffers to ride the turbulence of inflation and interest rates volatility. The bank has also chosen deliberately to build buffers on provisions, and we can see NPL coverage is at 95% on a cash basis point. And that then reflects how well it is. And the headroom to lending for opportunities, as we can see, the loan to deposit ratio is only at 66.9. So, and we optimize our profitability at 85% deposit ratios. And as we have seen, the returns are good. It can be better. Cost-income ratio moving the right direction, and we can continue to be a low-cost, high-volume margin bank. So broadly, that speaks to it. The forecast has remained what it is. Yeah, we are pushing on. Deposits are not, but we are confident. We have not changed the deposit forecast. Our 4th quarter is provides us with the best run for deposits. So we're still confident we'll show very, very good performance there. As we have seen, almost everything else is on target, exceeding expectation. The only other I want to highlight is cost of risk, slightly higher deliberately. The rest of the industry is half of our NPL coverage. We chose to do the coverage, and that is why slightly above to almost 100%, and that is why the return there. NPL, working very hard. Signs are we don't need to change the guidance. In the medium term, we'll be able to achieve objective, and the subsidiaries has performed much better, as we can see their contribution to profit before tax and asset contribution is spot on and target. And I want to give really a great applaud to our strategy team headed by Brent and Mary, John, our finance team headed by David for getting numbers spot on. You can rely on our numbers, you can rely on our forecast. We try our very best to keep on spot. So I think I will stop there. The other slides will give you. Today we are lucky, don't leave out your, it's already published, the investor briefing. So the presentation is a good coffee table book for you. and then we can see how we could be able to partner together and continue this journey. That brings it to the formal presentation, but I'll ask Brent whether there is something you feel I left out that you may want to highlight as we move on.
Great, thank you, James, and good morning, everyone. So maybe just to pick out some points that James has mentioned in his presentation and in his comments, I think it's important to highlight just the business model. And you'll recall that our business model is underpinned by two engines, the social engine and the economic engine. What is important to highlight is that this business model, the efficiency in which we can convert revenue into profit after tax is very efficient. If you do the calculation for our September numbers, you'll see it's at 34%. What this means is for every dollar that we generate as revenue, we are getting 34 cents in bottom line. And as we mentioned, we have a payout ratio of 30 to 50% of those earnings. What is also important to highlight is that the ability of us to improve that ratio, as James has alluded to, is there. And it's highlighted, or it's underpinned by our ability to shift the assets, as James highlighted, into higher yielding assets. It's also, you've seen the growth numbers in our trade finance, our FX. We've introduced a new business line in terms of insurance. So we are broadening and deepening our revenue streams, in particular to revenue streams that are high quality, high returning, and less capital intensive. The other aspect is as we grow these revenues and we efficiently put it to the bottom line, there is operational leverage. So James mentioned that, or essentially what's happening is as we grow revenue streams, it's not necessarily at higher incremental costs. There is an element where we have to continue to reinvest into the business, like what we're doing with insurance, what we're doing with our systems, automation, digitization. So there's an element of that, but that is coming with growth in our revenues. And as I mentioned, our efficiency in making sure whatever revenue we generate, it goes to the bottom line. Now, it's also important to highlight that this business model of ours is being applied in a region that is one of the highest growing regions in the world, as James highlighted. If you look at the IMF forecasts for the next 3 to 5 years, East Africa is expected to grow at least 6% real GDP. Nominal GDP, if you add inflation, will be around 13 to 14%. So I've talked about the efficiency of our business model. I've highlighted that we are growing in a very high growth region, and we're applying this business model to that high growth region. But also you can see our ability to convert economic opportunity into growth can be somewhat reflected in our earnings growth. So you have a region that is growing in nominal terms around 13 to 14%. We are growing our earnings at around 27%. And we expect to sustain this as well. So we have a business that is growing, that is in a high growth region. We can convert that economic activity to earnings or to revenue, and we can convert that revenue into a high proportion of earnings. Now, we're looking to do this in a lot more intentional way, as reflected in our Africa Recovery and Resilience Plan. We want to convert what is a high growth region, 6% real GDP, 14% nominal GDP, to even higher. This is underpinned by the fact that we are systemic, as James highlighted, in the markets that we operate in, so we have real impact. In Kenya, we are around 14% of banking assets. In a country like the DRC, we are around almost 30% of banking assets. So we are systemic. And with our systemic position, we can have real impact. So this Africa Recovery and Resilience Plan aims to take what is COVID and the Ukraine-Russia crisis has reflected how concentrated the world, or how reliant the world is on a very few. There lies in the near term some challenges, but more importantly, there lies in the opportunity over the medium to long term, which Equity Group looks to apply this business model into what we believe is a much faster growing region going forward. We're looking to really position the East African community in which we operate into the gateway into East and Central Africa. This is, the plan is really looking to transform wealth on the continent. It's taking the abundant resources that Africa is well endowed with, both in terms of agriculture and extractives, in terms of the commodities, and improving the productivity and the yields in those primary sectors. But for us, real transformation takes place when we value add the tea ourselves, where we value add the cobalt copper, which is looking to be converted into batteries. So we want to take those raw materials, improve productivity, value add, and we want to connect those that sell those goods. We want to connect them to markets. You would have seen a lot of trade missions that Equity Group has led, whether we're bringing Americans to the region, whether we bring Czech companies to the region, Belgian companies to the region, but also importantly, driving closer relations, closer collaboration and trade between the East African community countries. You would have seen in the presentation that we have signed agreements with the East Africa Continental, with the East Africa Continental Community Secretariat, the Africa Continental Free Trade Area Secretariat. These are very intentional activities by Equity Group to drive trade, and that you can see our intentions is being reflected in our numbers. You can see our trade finance is growing very high double digits. That is not coincidental. A lot of it is very intentional. So those are maybe just some of the comments I just wanted to bring out from James's presentation. Thank you.
Thank you very much, Brent, for really sticking to the strategic, maybe financial reporting. And maybe credit, what could I have said that I missed?
I think James highlighted, thank you. You'll note our tone when we're doing this investor briefing is very bullish. We're talking about growth, we're talking about transforming Africa, growing the wealth of our people. That doesn't mean we don't recognize that we're operating in a very difficult macroeconomic environment. And this is happening globally. The rising interest rates, the weakening local currencies, the rising inflation. That doesn't mean our people's disposable income is getting impacted. The investments that we are holding in government securities, there are rising interest rates, and with that does come a mark-to-market. There are borrowings that we have that now are experiencing high interest rates. On the economic engine side of things, I'd just like to highlight there's a very strong defensive side that is playing on the background to make sure that we are fortifying the balance sheet. We're making sure that our balance sheet remains strong so that our strategy in terms of growth and transformation remains relevant, it remains at full force. They do not need to slow down as this side is looking at making sure that we're managing our costs. You see, our cost to income ratio remains very competitive, it remains lowering. Just looking at DRC, in a year we reduced it by 10%, and that will continue to take it down towards the 50% mark. If you look at our cost of risk, which is fortifying the credit book. We do know that, with rising inflation, with decrease in disposable income, some businesses will come under pressure. And with that, our response is to fortify that credit book, increase provisions. We are not going to take any compromises in terms of our coverage. Our coverage remains 95%. We will aim to grow that gradually towards the 100% mark to make sure the existing balance sheet remains very strong. And I know a lot of comments have been made about, because of rising interest rates, Equity is the largest impacted bank in terms of mark-to-market. Our liquidity ratio is at 51%. At no point will we come under stress in terms of our liquidity that will necessitate us to liquidate these investments. Therefore, yes, there is an impact because of what is happening globally, but that will not impact us internally, because there's a very strong defensive side of the business that is making sure we have strong buffers in terms of capital, in terms of liquidity, to make sure the business keeps running. So just as we, transform and as we grow the wealth of our people, there's also a very strong defensive side that is making sure we are fortifying the credit book, we are fortifying our government securities, and our capital buffers remain strong to make sure that we remain true to the promise of a dividend payout. I think that's
Thank you very much, Mary. And lastly, maybe risk, Sam. What would I have said about the risks?
So the execution, very strong execution that we've seen, driven by significant investments in people, processes, systems. We've strengthened value propositions, customer products, come up with new enhanced products that suit our customers. We've upgraded systems and continue to upgrade systems, focusing on strengthening security within systems through closer monitoring of threats, remediation of threats, and also increased frameworks and policies to make sure that we upscale the business execution capability to match the ambition of the group. Thank you.
Thank you very much, Sam. So, Mary is in charge of governance and leadership in this organization. We are very, very grateful for the people who brought us this far. But Equity's regret in reporting is that the human capital is never factored in the balance sheet and the P&L. Maybe the secret will be out today, that this performance we are talking about reflect the quality of people we have in Equity Bank. It's the kind of decisions that they make that results to this kind of performance. Good decision leads to good outcomes, and good outcomes is good performance. I want to really applaud what has happened. And maybe I would ask the unsung heroes of ensuring that happen is 3 directors, Dr. Dorcas, maybe you could come forward, Dr. Beth, and David, Sir David. These 3, hey, it's good you come here. These 3, we owe them a lot in ensuring the bank is very, very well ably staffed. They are highly experienced, knowledgeable experts in HR, and they have really sharpened the skills and competencies of our people. And where we are growing faster than they can grow the capability, they have been able to attract great people within the organization. You have my respect, colleagues, for what you have done for us. And I think the best demonstration would be if we looked at the risk. They said, when you reach the top of the mountain, the risk increase exponentially. It is slippery because of snow on top of Mount Kenya. It's cold out there. let's strengthen risk. And some, we got some 2 years ago, but maybe Sam can get his team to start. The team that Sam has brought from ESG to all the other risks. Only 4 in the room. So Mike and Emmanuel heads the credit risk. Leshma, maybe Leshma heads ESG or sustainability. She likes calling it sustainability. Dawn heads what we could call fraud and forensics. And really we have gone very far, those who know. And my friend Tavel heads model risk, because we are now digitized. We are using engines, and that team has, I regret Thelma is not here. She heads, Thelma, you don't know you manage one of the risk. Cyber risk is managed by Thelma. And you can see the kind of resources they have put to their disposal. I regret Solomon and Kofi are not here, you know, and I feel confident. I now can sleep soundly because we have really strengthened the risk department. And that's why I thought I should show off with the team. I think special asset recovery, I thought that's also a risk management of default. Christine, Clement, and Eric. That team again is managing default risk, a dedicated team in my office, and they had done incredible. Equity is very young. As a bank, I think we were registered in 2005, 1st January 2005. But look at the skills that we have been able to build. Look at the maturity of the bank in its people, and that is what people don't see. They see figures. Figures are produced by great people who have really made very great strides. So we deeply appreciate that team for the great effort. And we couldn't have got that seniority. And as you can see, it's like a United Nations meeting. I think how many different nations are represented? If you don't come from Kenya, raise your hand. As you can see. Evan, I thought you are not Kenyan. I have learned you are Kenyan today. So I thought, Reshma, you come from Oman. You know, I know you a little bit more. So that is what they have been able to bring to us, a global capability, a global competence. And that's what we are leveraging on. Thank you, colleagues. You can sit. Thank you. Give it to them. Really. It's a real... And what does that also speak about equity? Because I have a few minutes. It talks about the environment we have created for people to thrive. That's why equity is able to attract the best the world can offer. That's why when they come, they're able to stay and coach and mentor our young generation. A couple of people have joined us recently. We know we have been struggling with the systems, but the system team, can you all be upstanding? Just to show how many people are in the room with the systems and digitization all together. That team is what, those who came from Tanzania don't want to start. I thought they were in systems. That's a whole team that has come to help us. That team, we believe, will sort out this challenge we have had the system. It's not a systems challenge. It's a good challenge because it reflects the very rapid growth. From 2020 to 2022, the balance sheet of equity doubled from 600 billion to 1.4 trillion, more than doubled. That's really the doubling is what has trained our systems a bit, stressed our systems. The digitization increased the transaction 56-fold. The transaction have grown in just that period 56 times, and consequently our system. But I'm glad to say, and General Marshall, maybe Marshall you could come, we believe we'll solve this problem. This man is named after General Marshall, those who remember, but he's Kenyan, Lusa, and he has just joined us from Accenture, where he was for 31 years, and headed us as their global MD. And we said, Accenture know how to deal with these systems, come and help our CIO, Dennis, you can raise. And today now we have a CIO and a CTO. And we believe with this we should be able to sort out the problem. Give us just a few days, and those transactions that I see on social media, and for which I deeply regret and apologize to those who are inconvenienced. We are doing everything humanly possible to give peace to our customers. 31 years of Accenture, all the way to the lead, dealing with nothing but technologies. We believe that team, we should be able to, within a short period, to be able to give us a solution. Thank you very much, Marshall, for the commitment to come and build that. So if you thought I was the only one with the gray hair, we compete with the Marshall, who has more. And we'll use the wisdom that we have accumulated. Marshall has been in Accenture for 31 years. I've been in equity for 32 years. And we are combining 60 years of work experience, from operations to technology, to solve that problem. And I can assure our customers, esteemed customers, as I apologize to you for what you are going through, that this is a short-term pain and we'll be able to resolve. Thank you very much, IT team. Your crap will come when the problem is solved. Thank you very much. I think we have also strengthened the credit a lot, other than on managing assets that are distressed. Chipo, who else have joined you with the credit? Very good. Chipo has joined us recently to head our credit, and we believe that with Emmanuel managing the entire credit risk, Chipo will be able to lead us. So broadly, in preparation for the future that we can see coming, we have strengthened our bench. And Marshall and the team are strengthening the systems. Mary and Sam are strengthening the governance and operational processes as much as we could to be able to orchestrate a good environment. And it's in that light that in its wisdom, the group board appointed our long-serving 24-year leader, Sam Kerobe, who was the managing director of Equity Bank Uganda, the founding managing director of Equity Rwanda, and the founding operations director of Equity South Sudan, to come back home. Yesterday was his first day to come and help us align two things: systems, processes, people, business risks, with the intentions of fulfilling the customer's aspirations. So we will no longer work as departments, we'll work now as team equity. And we now have the operational team captain help us to understand how that can be structured, and we believe equity will be different. Sam has a track record unparalleled in this bank, turbulence of South Sudan, I believe we are top bank in South Sudan, though small because of the size of the market. Rwanda, we are now number 2 bank. We are number 4 or 5 bank in Uganda, and that tour of duty has helped him to understand East Africa, and now can ensure the entire group is working in some, maybe some you could start, people can know who I'm talking about. So Sam was our first university student. We call them Equity Leadership Program. We got into the internship program. He was the best student in this district back in 1998. And since then, he has been in the bank, learned, and we are now using his expertise to now bring the operations together and really execute the operations. I think critical there, as we have said, is aligned systems, people, processes, business risk. But there is a team that is working specifically with, led by Victor. Victor, maybe you could start, Elizabeth, if you are near. That team, Elizabeth, is the one that is heading, Olainka is not with you, heading the scoring engines. And we are at a very advanced level. And that is why we had to get the risk of modeling, somebody who can look at that risk, because the engines are now automated. Decisions have been digitized, and Victor, we're proud of what is a business partner to Sam, so that Sam, who understand the operational computer environment, now help us to put the entire group into operation. So that broadly is the team. And thank you very much, the two of you. And I'll invite, if there are any questions that we haven't answered. We chose to make a presentation to answer your questions, but we can spend 30 minutes if there are additional questions. And be ready, colleagues, I can throw the question to you. Mine is the question to the right person. I'm glad there is no question. Oh, okay, sorry. Very good. Yes. Introduce yourself and then push the question.
Yes, good morning.
Morning.
Two questions, both to you. One is around credit, more of an industry question. We saw Starlink came and went, so the credit can and go. You had expressed some of the reservations and wanting more of the private sector to be growth in credit. Now we have a financial inclusion fund, aka Hustler Fund. I would like to know the impression it's created for you. I mean, will this be it in terms of economic credit, the private sector, for something you're thinking about? My second question is about credit to bear. CBK is running a credit to bear program of digital loans. That covers around 30 billion. I'm curious to know how much equity is taking on being one of the biggest lenders in terms of the digital loans, and how you are treating that on your balance sheet in terms of should we expect to see some write-backs of your digital loans, given that now there's that part of there's the forgiveness part on the borrower and also the 6-month stretch to do the credit repair program. Those would be my two questions. Thank you.
Very interesting questions. I never saw them coming. Well, let's try. You know, you don't like commenting on things that are outside your jurisdiction. The Hasura, FAD. What was the other one? No, there was a series of FADs. But broadly, we are very excited with the Hasura FAD ourselves. One, because it helps to de-risk. It completely helps to de-risk. You borrow 50, you borrow 3 times, we know you are a serious person. And what we have offered the government that we can scale the Hasura FAD to a fold of 5 times, 250 billion. You pay 2 times, then you are given a certificate and you graduate to equity borrowing. because we can scale the Hasra Fund, and we can give 3 times. Instead of the capping of 50,000, we can start them as they graduate with 150,000. So it is a very good, I would like to call it an incubation for Equity Group. That's how we see it. We see de-risking, we see inclusion, we see citizens reached out. We like the design, and for the first time, we applaud the government for the design because it brings financial discipline. And more importantly, the component that excites us is the savings component. We must really train our people to save. So the Hasra Fund has won our hearts because of its design. It is bringing financial, it's not free money, it is loans to be repaid. It is loans that you have to have credentials in terms of credit rating. It forces you to have a saving culture. So we think that is what the country needed. And then it reaches the masses. And the risk is being taken by government. So essentially, we're very excited about it. And we support it by scaling. People graduate from Hasra, government Hasra Fund to private sector Hasra Fund, so that essentially we work with our government to make it possible for all and to ensure everybody's dream is valid and every dream is funded to become a reality. In terms of the reset, while we have digital channels, we don't do digital lending. You know, digital lending is a product. We will use digital channels to do bank lending. So we have 0 of those loans. Those are the mobile loans, not the, as digital is a capability, it's not a product. But what the central bank is talking about is those banks and telecoms and fintechs that has created a digital product. We don't have digital product. We have bank products, but created digital capability of consumption. So for us, digital is a channel. So we are lucky that we organized ourselves differently. We think it was a good reprieve. I hope people will learn by paying the 50%. Initially, we were worried about the 4.5 billion because of the social hazards. If people take it that I can be defaulting and after 5 years I'm forgiven. But now this to me was a good compromise. Pay half of it, the banks will accommodate. So that reset to me is good for the economy because those 7 million people had been blacklisted forever. So this is more of like a remission, and we are proud that they have been brought back to the fold. As they pay, then they also now become eligible customers for equity, and we are seeing as a huge opportunity there. If you look at the number of customers during COVID, the banking industry almost lost 2.5 million customers, and to a great extent is because of blacklisting. So that is how we see it. Any other question or observation? Very good, Chami. Yes, Chami.
Doctor, before I comment anything, let me first of all take this opportunity to thank you. You seem to be very social, and you are driving up our bank upwards. You are really competing very highly with the other banks in Kenya. When I come and meet you, I see as if we are winning on top of the other banks. The system you have put in place In fact, all that activities are in your bank, other than other banks. Because when I go to the other banks, hakuna kitu inaonekana. Lakini kwako, I think you have made this bank to be so good that when I go, even if I don't have anything, I just sit and look at what you are talking and your staff. So let me thank Plant. Thank you very much. Asante sana, ladies and gentlemen.
Thank you very much, Mr. Chairman. Mary is not just in charge of subsidiaries, she's in charge of governance. So the strength of a train is not in its coaches, but the engine that pulls the coaches. Mary looks after the engine of the bank, which is effective corporate governance. She looks after development of leaders in the bank, and looks after the board and the functioning of the board. So the policies that runs this bank, Mary, it's at the center of it. Chami, you have reminded me maybe to recognize a couple of the people you have talked about, the social. The blood of equity is increasingly becoming more social, maybe overtaking the economic one. And maybe I will ask the directors of the foundation if you could start. That team of directors are the ones who are making things. Dr. Khalil there is in charge of health. Now she has 70 equity Afya centers run by about 120 medical doctors. This year, they will treat about 1.5 million patients. And I understand she's now developing an equity Afya health policy that will allow all the patients of equity Afya, they don't need to pay cash. They take an insurance. Ajara, next to you, the managing director of our insurance business, is now underwriting the health risk of our people so that health becomes affordable. The doctors that Dr. Khalil is using were trained by our Margaret, our director for education formerly. Director of education was Beth. Where is Beth? Trained those doctors. They went, they qualified. Now they are practicing doctors under the Equity Afya franchise. And it's all about. Saladin here work with about 18 development partners to look after vulnerable families, sustainability of people, social safety net. We support 5.4 million households at a time like this of great drought. I think I saw like we have paid 101 billion shillings to those families. So there's quite a lot that goes behind this engine to support society. The man inspects, Eric, you're going to wave, is the custodian of the environment. We know the environment belongs to all of us. We should give it to our children in a better state or future generation. We are just custodian. To date, he has planted or led us to plant 21 million trees. He has changed power source for 560 households with clean energy. So there's quite a lot going through. And the man of the moment is Anthony, who have trained 3.6 young people and given them loans to start businesses. Anthony is celebrating a program called Young Africa Works with the MasterCard Foundation. MasterCard gave us a guarantee to reach out to young, youthful people. He trained 480,000 on entrepreneurship and financial literacy, gave 281,000, 200 billion Kenya shillings. They have created 1,260,000 jobs over a period of 3 years. He has had 2 validations. So that is the social component. And again, behind what you see in Equity, there is somebody who is working very, very hard to make it happen. So even if you see me speaking on those TVs, it's the work of great team in Equity. And that leader explains what the strength is. Colleagues, thank you very much for great work that you have done. So that broadly is the social region. We want to change society. We want to change lives. We want to give people dignity. Like, look, we have now established branches in all our refugee main camps, whether it's Kakuma or where else? Dadaab, we have branches so that we integrate refugees with host community. Mary, I have a question for you. What is the earnings per share for Q3 and EVP before EBITDA multiple? What is the multiple and what is the return? Brent, you can help.
The earnings per share is 8.8 shillings per share compared to 7 shillings last year. On the multiple, if the person could send us a direct email, we'll be able to get back to them. I don't have that multiple on hand.
Okay, very good. These are online questions. What do you plan to extend the bank network in the East African community and the Great Lakes region? The commitment of the strategy of Equity Bank is to be in 15 countries and have 100 million customers by 2025. A very ambitious commitment, but that which will be achieved and delivered by the African Recovery Plan. We are committed and optimistic that we will hit the target of that plan. Among the countries that are starting on the plan is Burundi, the only country in East African community that we haven't established. Ethiopia has opened up. We have given feedback on the regulation we have seen, and we'll consider as government continue to improve. So that's also on the study. We like the Southern African region. It has become a very high natural resource region. It neighbors Tanzania. It provides us a route to DRC. So that region is of interest. How do you perceive the default risk on the Kenyan Eurobonds in your portfolio? There is this social debate about the risk of default. The Kenya government has spoken. The minister, the cabinet secretary of finance, who previously was the governor of Central Bank, has spoken. We have seen the arrangement the government has made with IMF. We are confident that the government, as it has stated, will honor its obligation as far as the Eurobond is concerned. We don't have long to wait, so we don't need to speculate. It's 2024. I think the signaling in the market of the ability of the government to honor its obligation seems to have worked very well, and we have seen the yields on the Kenyan Eurobond decline from 18%, a high of 22, down to 18, and now, Brent, we are down to what? 14.5. I think that is the greatest evidence that the market is not concerned or is confident of the government ability to do. The line with IMF gives us real confidence, tangible confidence that the government will be able to honor its obligation. And as we saw in the books, the sentiments had raised the yields very high, and mark-to-market was 66 billion, is now down to 44 billion. Again, which would say now it's not a default risk, it is more of the interest, the relativity, and it's unrealized, the relativity. And as we were assured that by Mary, Equity has the liquidity and will hold to maturity. So we don't, in our books, we don't see any risk as far as the Eurobonds are concerned. I think Brent, this is yours. What is the future economic plan for Equity Bank in terms of intrinsic value addition?
So the question is ultimately how we are positioning ourselves around positioning East Africa as a manufacturing hub. So a number of the initiatives really focus on initially connecting the value chain, so connecting the smallholder farmers to those that agro-process. You'll appreciate that a significant portion of agricultural output in Africa, around 60% on average, is from smallholder farmers. So we want to improve the yields and output of smallholder farmers. We have a number of initiatives that is looking to mechanize as well as to provide credible inputs to smallholder farmers. We will look to finance that. As James mentioned, we have Anthony and his team doing entrepreneurship training, financial literacy, essentially capacity building. Once we get that right, and ultimately the ambition is to make the region a net exporter of certain cereals, for instance, we want to take that higher output and value add it. So as Equity Bank, with all this funding that we have received in terms of deposits, our partnerships with the development finance institutions, we have long-term funding that we can support businesses to finance factories, build out their capacity, and give them financing for their working capital as they build out their capacity. So it's sequential. We're not just going to focus just on manufacturers. We are also connecting manufacturers not only to the raw materials, but also to distributors. So we are moving. I would not ask the question in isolation in terms of what we're doing with manufacturing, but this Africa Recovery and Resilience Plan is a holistic approach to transform wealth, which manufacturing is a key anchor to the plan and is a key anchor to value chains that we are targeting. As I mentioned earlier, real transformation of Africa will be determined on the successes on value adding our raw materials. So we've mapped out what is critical to this is a conducive environment to investment. At the end of the day, manufacturers that we're looking to finance rely on conducive government policies, tax policies to attract investment, to attract long-term decisions. So as governments have signaled that they are looking to put these conducive policies in place, we will look to finance this. And we have Kenya, we have Tanzania that are building out their access to ports, to rail, to road, which in turn provides the productive capacities for manufacturers to have reliable power, have reliable access to distribute their goods. So we've seen this investment taking place. What we've also seen in recent interactions with foreign investors, that there is real interest not only from regional businesses to invest in the region, but foreign direct investment beyond the region and beyond the continent. As I mentioned, we have hosted a number of countries as Equity Group, or at least supported as Equity Group, a number of trade missions from outside the continent, whether the US, the Czech Republic, and we're doing the Belgians as well. So there is a lot of interest in this Africa Recovery Resilience Plan. There's a lot of interest that the region is well positioned to be this alternative manufacturing destination. As I mentioned, one of the spotlights that Ukraine, Russia, and the pandemic, the COVID pandemic has highlighted, that manufacturing is highly concentrated. So Kenya, Tanzania, and the rest of East Africa is well positioned to do value addition. We're not doing this because we just think we need to do it. The region is well positioned to do it, and the region has put a level of investment that allows it to start building critical mass. You've seen a number of Asian countries that over the years have progressed from agricultural economies to agro-processing to more sophisticated manufacturing. East Africa is on that trajectory, and what we as Equity Group are looking to do is just accelerate that. So we are looking at agro-processing. A country like Kenya is well positioned to do diversified manufacturing from car assembly to pharmaceuticals. You just have to go to industrial area. You just have to go to Mombasa, Nakuru, Kisumu. You'll see a diversified type, you'll see a variety of manufacturing taking place. So we are not focusing on any one manufacturing sector. We are looking at all businesses that have the right governance, the right cash flows, but also we appreciate that there are entrepreneurs looking to start up as well in terms of micro, small, medium-sized businesses and looking to get into this space. And that is why we're in discussions with our partners for the guarantees. So again, I stress the point that we have this holistic approach of looking at the market and providing a holistic solution to the market as well. So thank you.
Thank you very much, Brent. And let me say there is enormous value coming from capacitation of the population through the work of the foundation, and huge contribution to aid, social interventions, including like to environment and the rest. There is a question here: what proportion of the bank's FX borrowers earn forex revenues, especially in Kenya? 100%. We never lend a client in foreign currency if the earning is not in foreign currency. So that is a prerequisite. And simply is to allow our clients to hedge against volatility. It could have been a disaster this year if you had a customer who was not earning in foreign currency and had borrowed in foreign currency. We read on floating rates, RIBOR plus. RIBOR has moved from 0.25 to almost 5. That's how much the interest rates in foreign currency. You can only hedge against that if you are earning to a great extent or to a full extent is in foreign currency. Ideally, while we talked almost 50-50, I think it's good for me to mention the bulk of the lending in dollars is in DRC, because that's a fully dollarized economy. The operating currency for DRC is US dollars. What was driving the deterioration in NPLs ratio during the quarter, and are you confident of achieving your full year NPL ratio? We're still committed to our target of NPL ratio. We're working very, very hard. The special recovery unit is almost in full gear. What really caused the deterioration was the bank recognizing out of the 7.7 billion of rescheduled loans that are coming into repayment in the last or the fourth quarter, 2.7 of it was training. And we decided to be proactive to downgrade the 2.7 billion into non-performing loans, and enhance the provision. And that explains why NPLs went up, and also cost of risk went up, and the coverage also went up. What is going to be your fourth quarter growth drivers? Or what are the drivers for the fourth quarter? As I said, naturally, the fourth quarter is always our best quarter. It's one, because we are dominant in agriculture, and the fourth quarter receives rains early in September, October, November, and there is peak agricultural produce activities during the festival seasons, either in the hotels or in our homes as we celebrate the holidays. So that is always a big driver. The second biggest driver that we are seeing now is deepening of digitization and convenience that we are delivering to our customer. And increasingly, the performance of the bank, as I said, will continue to strengthen because of the efficiencies that are being unlocked. The higher the volume of transaction, the greater the lower the unit cost, the greater the efficiencies. The third factor or driver of anticipated superior performance is greater reallocation of funds held in government stocks, which is low-yielding assets, to high-yielding loan book. So we are seeing that as a very significant shift, and to continue to increase the momentum in terms of performance. I would add those three, but I will ask Mary, is there any other, Mary, that is likely to be a big driver for the fourth quarter?
No, James, you've covered.
Maybe I would say the people factor. As we train, as we develop, as people settle, we expect. Hopefully, the target that the Chief Operating Officer has been given of realigning, that alignment of policies, of risks, business risk, procedures, systems, people, business, to the interest of the customer, to the aspirations of the customer, to the market, hopefully will transform this bank and start demonstrating outcomes. I want to thank you all for your excellent questions and the 2 hours that we have spent together. It's always a pleasure for us to start before the investors, the analysts, the media, our shareholders, and our partners to discuss our common owned business. We have an alignment of interest wherever we speak together and we work together. I want lastly to invite you for a cup of tea, but I will ask Bishop Kariuki to speak blessings to you as I wish you Merry Christmas and Happy New Year, because there is no other investor briefing before the end of the year. Thank you very much and a great day.
Thank you, James. And let us pray. Father, we thank you and we bless you so dearly for your blessings upon us. We thank you for the results of Q3. We are grateful that, Lord, you've been there with us and you have helped us. And this morning we want to say we owe you our gratitude for your unfailing love and favor. We also want to thank you even as we go forward, looking forward to close the year with good and better results. We do know that beyond every mountain, there are other mountains. Lord, how we pray that you hold our hands and help us to move and do even greater for the glory of your name. We want to thank you for that wonderful meeting. And now, as we come to the end, we have our breakfast that we are going to share together, how we pray that you bless it as we take it, and as even we part and to embark on our responsibilities and work ahead of us today, how we pray that you give us a great day. We thank you and we bless you. For this we pray in your holy and precious name. Amen. Thank you.
When dealing with foreign exchange, time and speed is of essence. Sometimes there is no time to visit a branch or make a call to negotiate for forex rates. This no longer needs to be a problem. Introducing EasyFX, a secure and convenient platform that gives you the freedom to buy or sell foreign currencies in real time. With EasyFX, you can enjoy access to competitive forex rates, real-time deal settlement, place buy and sell orders, real-time streaming of rates across various currencies, and a history of all your forex transactions. Transacting on EasyFX is easy and fast. Log on to EasyFX. Select and add in your currency pairs. Enter the date, amount, value date, select type of trade, and your transaction is complete. Buy and sell forex at the touch of a button. Sign up for EasyFX today and make forex easy.
Every day, we empower our members to innovate, to create, to dream. And every day, they're transforming Africa. Equity. Karibu member. Every day, we empower our members to unite, to inspire, to triumph. Equity. Karibu member. Every day, we empower our members to connect, to create, to prosper. And every day, they're transforming Africa. Equity. Karibu member.
Equity only calls you from 0763 000 000. Now you can be sure it's Equity calling. Our number is verified on Truecaller. Here's what to check: green background, Equity logo, the word Equity, verified icon, and business badge. Report suspicious callers by SMS to 333 for free. Be sure it's Equity calling.
Every day, over 15 million members are transforming Africa. Karibu Member.
It's the dawn of a new day over Mbeya in Tanzania, a country that has the potential to supply food to the region and particularly rice, for which it has a clear comparative advantage. Rice as a food and cash crop is the second most treated cereal in Tanzania after maize. It is grown in many parts of the country, but mostly in southwestern region where farmers grow the crop by irrigation and rain-fed production. Mbeya rice lands account for most of the national rice output. Most of the rice produced here is high-quality Salo rice variety. A significant proportion of the lower-yielding but more aromatic rice, Mwenda Mbio, is also grown here.
Tuna mpango wa kutafuta masoko nje kwa sababu mashine ya kumenyea tunayo. Godown la kuhifadhia tunalo. Kwa hiyo issue hapo ni kutafuta, tuna mpango wa kutafuta masoko nje ili tuweze kuuza mchele badala ya mpunga. Tukipata soko Kenya, tukipata soko Uganda, tukipata soko Malawi, madam liwe soko tu lenye tija.
Naishukuru serikali kwa sababu kwanza imetujengea miundombinu. Tuna mifereji sisi hapa. Kwa maana hiyo tunaweza kulima wakati wote. Naweza kulima wakati wa kiangazi, naweza kulima pia wakati wa masika. Na hili bonde letu linakubali muda wote kufanya kilimo hiki cha mahindi.
The prospect for export of rice to the East African Community member countries, which now includes the Democratic Republic of the Congo, is immense. Kenya alone is a huge market. With an annual demand for almost 1 million metric tons against local production of only 180,000 metric tons, the shortfall is met by shipped imports from faraway Thailand, Pakistan, India, and Myanmar. A sizable 37,000 metric tons are hauled in by road from neighboring Tanzania. A review of the rice subsector by Equity Bank revealed that financial support of the whole rice value chain would not only increase production but also increase stakeholders' income to ultimately transform lives and livelihoods. Equity's initial partnership with farmer members of Ipatagwa Rice Scheme reveals that there is a hunger for support of rice farmers who own between an acre and 10 acres. While financial support is necessary, entrepreneurship training is critical to ensure farmers practice farming as a business.
Sasa wewe kujua kwamba kule kuna soko, unahitaji mtu wa pili kukupa jicho, si ndio? Sasa ndio maana hiki kitu tumekuja sasa. Kuhakikisha kwamba tunaunganisha wakulima wetu, wazalishaji na masoko ambayo yako nje ya Tanzania. Kwa maana kama kuna watu wako Kongo, wako Rwanda, wako Kenya, basi wapate kujua kwamba sasa hizi tuna mchele ambao tunategemea wapi? Isenyera.
Mimi na familia yangu tunalima eka 7 za mpunga. Equity inawahisha mkopo kuletu. Kwanza haina usumbufu wowote. Sisi wakina mama tukikopa hiyo mikopo itatufaidisha sana kwenye kilimo, hasa hata kwenye pembejeo. Sisi wakina mama tukipata pembejeo nasi tutakuwa juu zaidi.
Tangia mwaka jana 2021 nimeweza kuingia kuomba mkopo katika benki ya Equity. Kweli niweza kuomba milioni 5 na benki ilinipa kwa muda mwafaka. Nilikuwa ninalima ekari 3 lakini kwa 2001-2002 nimeweza kulima ekari 12 na nilivuna gunia 187.
Ipatagwa scheme is but one of the 5 rice schemes that are over 1,500 acres each, with Mbuyuni at double that acreage. In all these schemes, rice is grown by irrigation from waters drawn from Kimani River, a tributary of Rufiji River downstream. During Nane Nane celebrations held in Mbeya, Tanzania President Samia Suluhu Hassan re-emphasized the importance of rice production at an event where farmers received delivery of power tillers from Equity.
Mheshimiwa Rais, tumetumia kama wakulima wa kikundi cha Ubaso kutoka wilaya ya Mbalali. Tumeanza kunufaika mwaka wa jana 2021-22. Tumepewa pawatila 35 kutoka Equity na trekta moja aina ya Mahindra. Zimetusaidia kutoka kwenye kipato cha gunia 15 mpaka kufika gunia 40 kwa heka moja.
Katika mwaka 2021, sekta hizi za kilimo zilichangia 26% kwenye pato la taifa. Zikatoa ajira kwa wananchi wastani wa 65.6 na kuchangia 65% ya upatikanaji wa malighafi ya viwanda. Pia zilichangia kiwango cha utoshelevu wa chakula kinachozalishwa hapa nchini kwa zaidi ya 100% na kuzalisha ziada kwa ajili ya soko la nje. Hata takwimu kutoka Benki Kuu ya Tanzania zinaonyesha kwamba katika mwaka 2021 bidhaa ya mchele pekee imeingizia taifa jumla ya shilingi bilioni 476.8 ikilinganishwa na shilingi bilioni 176.5 kwa mwaka 2020.
By far, the most challenging aspect of the rice value chain is marketing. A director of Ruhie Rice Milling and Warehousing Service Company, Raphael Mbaise, has 55,000 bags of paddy in his stores. The farmer Kamila started with 1.5 acres of land under rice, but today he produces rice on 200 acres. With 20 tons milling capacity per day, Mbaise could clear his warehouses by milling the paddy, but instead he staggers the milling because of a constricted market outlets. Mbaise's views have advised Equity's determination to partner with stakeholders on the rice value chain to provide project finance for warehouse construction and payment solutions for wholesale and retail traders.
Our rice is sold in various regions, say Dar es Salaam, Zanzibar, Tunduma, and Mwanza. But all these points, they are related to outside the country. So those who are taking our rice to Tunduma, they are looking at the Congo market. And those who are going to Mwanza, actually, they are going to Kenya direct.
The bank is ready to provide asset financing for mechanization of farming and for transport of exports and imports to various destinations across East Africa.
So we as Equity Bank, we have committed that we'll link our farmers to those markets because they appreciate that buyers from Congo DRC, buyers from Rwanda, Kenya, they offer them a reliable market and good price for their produce.
Rice is not the only crop grown in the region. Maize, the most traded cereal in the country, is also grown here alongside wheat, beans, peas, and soya. Indeed, not far from the rice fields of Ipatagwa is the maize growing farmlands near Ilaji in Uswahilini. Maize is grown by irrigation and from rain in season.
Nimejipanga Equity ikinipatia mtaji niweze kulima zaidi hata ya eka 5. Natarajia kuuza soko la Inyala. Natarajia kuwauzia watu wa aina mbalimbali, kwa mfano Kenya, Malawi wanakuja kuchukua zao letu la mahindi.
Kweli kuna changamoto kubwa ambazo huwa zinatukabili sisi kama wakulima wa kilimo cha mahindi. Changamoto ya kwanza ambayo ndio kubwa ni ukosefu wa mtaji. Kwa sababu tunashindwa kuzalisha mazao mengi kwa sababu hatuna mtaji ambao utatuwezesha kuweza kununua pembejeo za kilimo kwa wakati, hususan katika upande wa madawa na upande wa mbolea. Halikadhalika hata mbegu bora ambazo tunaamini kabisa Equity Benki wao wakiweza kutuwezesha, tunaamini tunaweza tukatatua hizo changamoto kwa wakati.
With a 200 million people market in the region across the middle of Africa, trade in agriculture will grow, supported by Equity's Africa Recovery and Resilience Plan.
The strategy we have adopted is the African Recovery and Resilience Plan. We have leveraged on the East African Community Common Market and leveraged on the African Continental Free Trade Area. It's a regional plan, it's a continental plan, because we have realized the only thing that can support us to succeed is the market. The larger the market, the better.
Agriculture industry players in Tanzania and across the East African Community member states are encouraged to tap on the 700 billion Kenya shillings plan to feed the region.